Hello everybody, welcome back. Just a real quick update on this Bitcoin situation. So Bitcoin, appears to be, I'd say, consolidating in what looks as though it could be a bull flag, which would allow it to move up and into the $20,000 and way above, and that could all quite easily still happen. But there's a few things that are roughly sort of beginning to concern me. So first of all, CME futures are net short. So that's one thing to be aware of, that they've got more short positions than they have long positions, and they have done since we hit 19,000. So a lot of them are still around this level. Some of them still in profit. Some of them will be significantly in profit, but around about the $19,000 zone, a lot of those shorts came into fashion. And you could also see on here that these shorts are kind of up and down below the 70% mark, but generally speaking the longs are quite hefty on the retail side of things. What we're looking at basically is a resistance line here. This resistance has been, it's nothing to be concerned about, but it has proved to be, relatively strong in the short term. We broke above it ever so slightly, but this is all part of what was a triangle formation, right? Like a wedge, and the wedge has broken down, to the down. It looked a little bit more like this. But basically what happened is that we come to the end of that wedge, so the wedge isn't relevant anymore. And also what generally happens is the longer it takes for you to break out of a wedge, the more likely it is that whatever move is going to be weak. So what we got is we got ourselves broken out of here towards the edge, very end of that wedge, and it was pretty weak, and now it's breaking down, which is not uncommon for that kind of formation. What I'm looking at now is on the hourly chart, we've got a green 50 exponential moving average, we've got a white 200 exponential moving average, and these two basically are very common in dictating the next direction to come. Now they're both lagging indicators, and which basically means they don't lead you into any direction. What they do is they direct you into a continued direction. Being above both of them is very bullish, being below either of them is kind of bearish, but being below either of them is quite bearish as well. But bear in mind, this is just an hourly chart. Now if we go to the MACD is neither here nor there. It's dancing around this 0 point currently beneath it, which is neither here or there. One flow index is actually trickled down to quite low areas, which could suggest that on the next big dump there would be a decent buyback. But the thing is about these exponential moving averages is the last time we had a negative cross on these two was all the way back down here. We're going to have to retrace all the way back down to almost $10,000 really, where we were basically finding our feet before this big bull run. Now we've had this cross take place from here at 10,600, and only when we had that giant big dump was it forced into a cross, which is natural because that was a giant move. That moving average obviously followed with it, but was brought straight back up and had made a cross. That was an unnatural forming of what could be considered, or technically is, a death cross, but not really, as it's only an hourly formation. Now what we're looking to see is this direction looking strong or weak, and we've not had that cross yet, but it is kind of looking like it might forge over the next 24 hours if the price doesn't pump. Now we are back beneath this resistance zone, and again, this is just an hourly chart, but we're back beneath the resistance zone. If we were to break out of here, this would be okay, this would be avoided, but if we still stay at this current level or below, so we're talking 18,800, then that will cross, and that might govern a small term, but reasonably, maybe for the rest of the week, downtrend. Now if we're looking here on the daily chart, we see something also quite interesting. Now there's a lot of lines here, and we'll get rid of the vast majority of them. We'll get rid of all of them. In fact, we don't need these to get this point across. This is all we really need to see, is the Bollinger Band. So the Bollinger Band is basically moving averages in themselves, and what we see is the centre of the Bollinger Band, which is finally, for the very first time, caught up with the price. Now this is natural behaviour, and this is the kind of thing you'd often see before a push up. So you've come down to this level. Like I say, it looks a bit like a bull flag. And we came down to test that for the first time naturally for a very, very long time, again since all the way back down here at that level, roughly, that level that we were at before when we were looking at the last time there was a cross. So around about 10,600, we've not really tested it, other than that that big sell-off that we had when we approached the all-time high for the first time. So the important thing to note here is that smaller term timeframes do then correspond to larger term timeframes, and when we're looking at these exponential moving averages, we do have an idea, not that one, we do have an idea of what this implies. If this makes a cross, it would mean a continued trickle down. So this consolidation, or this this bull flag, has some more room to move. Now, it's not the end of the world. This obviously doesn't have to end there. This can continue all the way down. It is resistance, and we could continue being pushed down and use this as a resistance. What we really want to see is we want to see a significant push above here and closing above here and making a higher high. Not like this, where we broke above it, came down to test it, broke down beneath it, up again, lower high, and now we're back down beneath it again. Once this crosses, then we're probably going to keep underneath this as a resistance. Now, again, it's not the end of the world, and I'm not calling for like a massive dump or anything, but it does raise a few a few red flags. Maybe something to consider, that we might not be ready for the all-time high quite yet. We might not be ready for the $20,000 quite yet. We might be ready for it, in a few weeks, but we're not ready for it now. And this might suggest that we break down beneath the center of this Bollinger Band, being 18,600. And if that happens, that'll be okay. But then that would likely turn to resistance too. The bottom of the Bollinger Band area here is 17,200, which is also where the CME gap is. So breaking down below here, Bollinger Bands, the way that they often work is that if you're above it or below it, whichever side of the center you're above or below, you're more likely to stay in that 65% of the time. So you're more likely to stay above it now. So at the moment we're more likely to stay above it, and the chances are we will, statistically speaking. But if we break down below it, which we might, then it would prove to be resistance statistically, because we're more likely to stay below it 65% of the time. So this would be considered a downtrend or a further consolidation, and the bottom of it right now, even though it's still upwards facing, is the CME gap, which is 17,220 thereabouts. So it's not the end of the world, but it kind of does look like a consolidation may take place. But neither of these things that I've mentioned are confirmed, but these are the things to look out for, and if they do start to kick in, then it would be, so, I'm not going to tell you what to do with your money, but this is the very basics of how trends are formed. And if there is a downtrend formed, we will know about it, because we'll be closing beneath the center of this Bollinger Band for the very first time since around 10,600, and we would also have the hourly cross for the first time since 10,600. So maybe I should have made this video if this cross took place. But again, these videos aren't signals. I'm not making signals for people. These are just, I suppose, learning tools, and this is one of the most basic things to look at, to try to preempt the direction. And the hourly time, the hourly will then correspond to what could be the 4 hourly. And if you ever got a cross on the 4 hourly, that generally is a death cross. The 4 hourly counts for something. The lower term timeframes don't count as a bearish signal. The 4 hourly would, but I don't think we're going to be getting a death cross on the 4 hourly for a very, very, very long time. Anyway, I'm going to leave it with you there. Thank you for watching. Oh, and by the way, if you've not already got a Binance account, or if you do and you want to make some savings, set yourself a new Binance account up. You don't have to verify all your Binance accounts. I've got 3 of them myself. You get 20% of your own fees back in commission, so basically you're just getting given your money back off trading. Really, there's really no need to be paying more than you normally do. So like I say, I've got 3 Binance accounts. I've got my original one, which is all verified with IDs, because I was buying and selling fiat currency. But if you're not doing that, you could just simply set a new one up with this code and do plenty of trading on that. And as long as you're not wanting to buy or sell with fiat currency, you don't need anything other than an email address and a Google authentication code to get in and out of your account fine. So it's something for you to consider. I know a lot of people have started taking me on this offer now, because you're saving a lot of money. If you're a hardcore trader, or if you're a frequent trader, why pay more fees? Anyway, I'm going to leave this video with you there, but like I say, thanks for watching. I hope you have a nice evening. Take it easy.